Welcome to The Explainer. Today, we're going to pull back the curtain on the invisible language that runs pretty much everything, economics. We'll break down the powerful forces that decide the price of, well, everything you buy, and what happens when the whole economy hits a bit of a rough patch. Okay, let's jump right in with a question you've probably asked yourself about all sorts of things, from concert tickets to plane tickets. Back in 2009, the New York Yankees opened this brand new $1.5 billion stadium. And they jocked up the ticket prices, thinking, build it and they will come. Well, they were wrong. Thousands of the best seats, some going for $2,500 a pop, just sat there, empty. It looked so weird on TV. So what on earth went wrong? So what's really fascinating is how teams have figured this out now. Take a look at this. It's a peek at how the San Francisco Giants do their pricing. See how a game against a huge rival, like the Dodgers, costs more than one against the Diamondbacks? Of course it does. And a seat right behind home plate, way more than one out in the bleachers. This is what they call dynamic pricing, and it's all about reacting to two incredibly powerful forces. And those forces are demand and supply. Honestly, they are the basic rules of the entire economic game. For right now, let's just focus on that first one, demand, because it's the key to understanding the price of everything from your morning coffee to a new car. So first up, we have the law of demand. And this is something you already know. It's super intuitive. When the price of something goes down, people are willing and able to buy more of it. Simple. When the price goes up, they buy less. The Yankees completely ignored this basic law, right? They set their prices way too high, and the quantity of tickets people demanded for those amazing seats dropped to basically zero. And this isn't just some random thing, it's all based on how we as humans behave. I mean, if a product gets too expensive, what do? You look for a cheaper option. That's the substitution effect. And when a price drops, suddenly your wallet feels a little fatter. You have more purchasing power. That's the income effect. And finally, let's be real. That fifth slice of pizza is never as good as the first, is it? That's diminishing marginal utility. You're only going to buy that fifth slice if it's cheap enough. But here's the million-dollar question for anyone selling anything. How much will people change their buying habits when the price changes? This is what economists call elasticity. For some stuff, like gasoline, demand is pretty inelastic. You still have to get to work, right? So even if the price doubles, you'll complain, but you'll probably buy almost the same amount. But for other things, like a new car, demand is super elastic. If the price jumps 20%, you might just say, you know what, my old car's fine, and demand drops off a cliff. Okay, so this does a great job of explaining how a single market works, whether it's for cars or baseball tickets. But these same forces, all this buying and selling, spending and making stuff, they're also happening on a massive national scale. So let's zoom out. Let's go from looking at one market to the entire economy. When we look at the economy as a whole, it's not a straight line of constant growth. Nope. Instead, what we see is this kind of roller coaster, a pattern of ups and downs. And that's known as the business cycle. It's a totally natural, even if it's sometimes painful, rhythm. So this cycle basically moves through 4 stages. It starts at a peak. That's when business is booming and jobs are easy to find. But, what goes up must come down. That leads to a recession, where the whole economy shrinks a bit. The bottom of the ride is called the trough, where things finally level off before we start climbing back up during the recovery on our way to the next peak. Now, this is a really important point. A recession isn't just a slowdown. It's not just that the economy is growing more slowly. It means it's actually going backward. We're producing less, earning less, and employing fewer people. And a really powerful and kind of scary example of this was the Great Recession. It all started in one corner of the economy, the U.S. housing market. But when home prices fell and people couldn't pay their mortgages, it created this domino effects that triggered a full-blown crisis across the entire financial system. It just goes to show how connected everything really is. So this begs a huge question, right? If the economy is like this massive ship getting tossed around in a storm, is anybody even at the helm? Are there pilots trying to guide us back to calm waters? And the answer is yes. There are 2 main pilots. Pilot number 1 is the government. We're talking Congress and the president. And the main tool they use is something called fiscal policy. It's all about government spending and taxes. So how does that work? Well, to fight off a recession, the government really has 2 big moves. It can start spending more money itself. Think of big projects, building roads and bridges, which creates jobs right away. Or it can cut taxes. That leaves more money in your pocket or in a business's bank account with the hope that you'll go out and spend it.
Either way, the goal is exactly the same: get more spending happening in the economy. All right, that's pilot number one. Pilot number two is the nation's central bank. Here in the US, that's the Federal Reserve. You've probably heard them called the Fed. And their main tool is called monetary policy, which is all about managing the money flowing through the economy. Now, the Fed has a few tricks up its sleeve, but its number one go-to move is something called open market operations. I know it sounds super complicated, but the idea behind it is actually pretty straightforward. It just means the Fed is buying and selling government bonds with regular banks. So let's walk through how this works to get things going again. When the economy is weak, the Fed buys government bonds from banks. Think of this as a direct cash injection right into the banking system. Suddenly, the banks have a lot more cash just sitting there. And what do banks want to do with cash? They want to lend it out. So to get you and me and businesses to borrow, they lower interest rates. That makes it cheaper to get a car loan or for a company to build a new factory. See? Whether it's the government spending more or the Fed making it cheaper to borrow, both of these pilots are trying to do the exact same thing. They're trying to influence what's called aggregate demand. That's just the total amount of spending in the entire economy. They want to steer us away from those nasty recessions and towards their big goals: stable prices and everybody having a job. So why does any of this matter to you? Because this isn't just some abstract theory from a textbook. This stuff is a toolkit. It's like getting a new pair of glasses that lets you see the invisible code that structures your world every single day. From now on, when you hear that gas prices are going up because of increased global demand, you'll actually get what that means. When the person on the news says, "The Fed cut interest rates today," you'll know exactly what process they just kicked off. You'll be able to see how a tax cut isn't just a political argument, but a real policy that could actually affect your job. So here's the big takeaway. Economics isn't some far-off science happening in a classroom. It's the operating system for our daily lives. From the price of a ticket to the health of the global economy, these forces are always at play. Now you have the lens to see them. The only question is, what are you going to see?